Like the idea of investing in a business that's been around for nearly 200 years? Want a market-beating yield, a double-digit dividend growth rate, and a perfectly balanced payout ratio? Looking for an under-the-radar dividend growth stock that appears to be cheap? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before we get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for our special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is providing specialty glass and materials to all kinds of industries. What do televisions, smartphones, and optical fiber all have in common? Glass. But not just glass, specialty glass. The kind of specialty glass that this company manufactures. There's a good chance that the device you're using to watch this very video with is using glass from this company. And because just about every industry it works with is in serious growth mode, the company is poised to grow its own revenue, profit, and dividend for years to come. I've personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. By the way, I explain exactly how I achieved financial freedom in just 6 years in my early retirement blueprint. If you're interested, you can download a free copy of my early retirement blueprint using the link in the description of this video. Getting back to the stock I'll tell you about today though, perhaps best of all, it looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Corning Incorporated, which appear to be trading at a significant discount today. Corning Incorporated, stock ticker GLW, is a multinational materials science company that manufactures specialty glass, ceramics, optical fiber, and related materials. Founded in 1851, Corning is now a $28 billion by market cap materials mammoth that employs more than 60,000 people. The company reports results across 5 major business segments: optical communications, 31% of fiscal year 2021 sales, display technologies, 26%, specialty materials, 14%, environmental technologies, 11%, and life sciences, 9%. All other accounts for the remaining 9%. Corning is an under-the-radar company at the forefront of various technologies. We're talking about optical fiber for internet access, glass for smartphones, and specialty materials for advanced R&D processes. There's a good chance that the glass you're interfacing with right now, in order to consume this piece of investment research we've made for you, was manufactured by Corning. Corning is a proven leader in specialty materials, showing its ability to innovate and stay ahead of the pack for many decades now. Morningstar puts it like this, and I quote, "Corning is a materials science behemoth with differentiated glass products for televisions, notebooks, mobile devices, wearables, optical fiber, cars, and pharmaceutical packaging. In its 107 years of operation, the company has constantly innovated, including inventing glass optical fiber and ceramic substrates for catalytic converters, and oriented itself toward evolving demand trends that it can serve through its core competency of materials science. Most recently, we point to Corning's domination of the smartphone cover glass market and deals with US network carriers to supply fiber for 5G buildouts as evidence of the pivot toward growth," unquote. I think that says it all. This company hasn't been around for almost 2 centuries by accident. A lot of the tech we use and take for granted doesn't really exist without Corning, and I'm quite confident that the tech of tomorrow, which is even more exciting, will be possible because of Corning. That's what bodes so well for this company's ability to continue growing its revenue, profit, and dividend for many years to come. As it sits, Corning has increased its dividend for 12 consecutive years. The company's 10-year dividend growth rate is 13.4%. What's especially impressive here is the consistency of double-digit dividend raises over the last decade. Even the most recent dividend increase was 12.5%. I see no real deceleration in the rate of dividend growth here. Meantime, the stock offers a market-beating 3.2% yield to go along with that consistent double-digit dividend growth. By the way, that's 60 basis points higher than its own 5-year average yield. Another great thing here is the payout ratio of 50.2%. That's perfectly balanced between retaining earnings for business growth against returning capital back to shareholders. I like dividend growth stocks in what I call the sweet spot. That's a yield of between 2.5% and 3.5% paired with a high single-digit or higher dividend growth rate. The yield is on the high end of the sweet spot, while the dividend growth rate exceeds what I'd usually look for. Great dividend metrics. Looking at business growth, Corning increases revenue from $8 billion in fiscal year 2012 to $14.1 billion in fiscal year 2021. That's a compound annual growth rate of 6.5%. Solid top-line growth. Earnings per share moved from $1.09 to $2.07 adjusted over this period, which is a compound annual growth rate of 7.4%. Again, solid. Corning isn't lighting the world on fire with business growth, but it's moving the needle at a good pace. Substantial buybacks have aided growth on a per-share basis. Corning's outstanding share count has been reduced by 45% over the last 10 years. That's one of the most remarkable reductions I've yet come across. However, steady margin erosion has worked against the firm. Looking forward, CFRA forecasts that Corning will compound its earnings per share at an annual rate of 24% over the next 3 years. CFRA points to their view that quote-unquote demand is beginning to recover across end markets. This number, if it ends up actually transpiring, would represent a meaningful acceleration in bottom line growth. While it does look rather aggressive to my eye, I must say that Corning is coming off of a terrific fiscal year 2021. Revenue grew by 24.5% year over year, and free cash flow nearly doubled year over year. It remains to be seen how the company finishes this fiscal year, let alone the next 3 years, but Corning doesn't need to compound its earnings per share at a 24% annual rate in order for long-term investors to get enthusiastic about investing in the business. If the next decade ends up looking like the last one, that'd be supportive of a strong total return package. Multiple levers can be pulled toward this end. If management can keep modestly growing sales while simultaneously improving margins and aggressively buying back shares at these low levels, you have the recipe there for plenty of EPS and dividend growth. To repackage an old adage from Warren Buffett, Corning appears to have a 1-foot bar that can easily be stepped over here. And if CFRA's number is closer to reality than I think it is, all the better for shareholders. Either way, I don't see how Corning doesn't announce at least high single-digit dividend raises annually over the foreseeable future. Layering that on top of the 3.2% yield leaves little to be desired, in my view. Moving over to the balance sheet, Corning has a very good financial position. The long-term debt-to-equity ratio is 0.6, while the interest coverage ratio is over 9. Profitability is the one area where there's a lot of room for improvement. Over the last 5 years, the firm has averaged annual net margin of 4.7% and annual return on equity of 5.8%. The good news about this profitability situation is that there's tremendous opportunity for management to pull this lever, expand margins, and accelerate earnings per share growth over the coming years. Overall, I see Corning as a great business with the potential to become even greater. And with economies of scale, IP, vertical integration, R&D, and switching costs, the company does benefit from durable competitive advantages. Of course, there are risks to consider. Regulation, litigation, and competition are omnipresent risks in every industry. The company faces technology risks, and Corning must continue to innovate in order to not get left behind. Corning's end markets are sensitive to economic cycles, which leaves Corning somewhat vulnerable to a recession. Vertical integration is an advantage, but input costs are rising. Being an international organization, the company is exposed to currency exchange rates and geopolitical risks. The company is mildly acquisitive, which introduces execution risks. I believe these risks are really quite acceptable, especially when weighed against the quality of the business, and the valuation, which currently looks attractive, adds even more weight. The stock is trading hands for a PE ratio of 15.8. That's a very undemanding earnings multiple. There's also the price to cash flow ratio of 9.6, which is well off of its own 5-year average of 11.1. And the yield, as noted earlier, is significantly higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 7%. That is almost right in line with the company's demonstrated EPS growth over the last decade, with a small margin of safety thrown in for good measure. Now, this looks very conservative next to the expectation for earnings per share growth over the next few years. The 10-year dividend growth rate is much higher than this, and the payout ratio is just about perfectly balanced. However, I'm not quite as sanguine about the growth projection as CFRA is on the earnings per share side of things. I think I'm looking at a firm here with a high single-digit earnings per share growth profile with the possibility to improve and do even better, but I'd rather err on the side of caution and lean heavily on what the company has already proven out. The dividend discount model analysis gives me a fair value of $38.52. The reason I use the dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since a dollar tomorrow is not worth the same amount as a dollar today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates Corning as a 4-star stock with a fair value estimate of $40. CFRA rates Corning as a 5-star strong buy with a 12-month target price of $40. I came out slightly low, but we're all in a pretty tight range. Averaging the three numbers out gives us a final valuation of $39.51, which would indicate the stock is possibly 17% undervalued. Here's the bottom line, guys. Corning Incorporated is an under-the-radar business that puts up really good numbers. Based on what I'm seeing, those numbers stand a good chance of getting even better. With a market-beating yield, a double-digit dividend growth rate, a perfect payout ratio, more than 10 consecutive years of dividend increases, and the potential that shares are 17% undervalued, long-term dividend growth investors should definitely have this name on their radar. And now for a special news announcement. US Bancorp, stock ticker USB, just got upgraded by KBW analyst David Conrad to outperform from market perform based on a quote-unquote deep discount to historical valuations. Conrad points to US Bancorp's 4% discount on price to tangible book value versus peers, which compares to a 55% historical premium. We covered this high-quality regional bank only a few months ago, estimating fair value at $57.54 per share. Shares are currently selling for less than $44 each. Opportunity? Well, David Conrad seems to think so. I'm inclined to agree. Thanks so much for watching. Hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It'll allow me to retire in my early 30s. I've made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell stock. I put my money where my mouth is, and I'm often invested in the same high quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you can benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.